course, and its course is on fixed income securities, and we will be starting from this little textbook. Maybe you can zoom in. Can you zoom in on the textbook, including the author, Frank Pabazzi, Bond Markets Analysis and Strategies. You zoom in real nice?
Yeah.
Is it real good? Okay. And we basically begin, this is lecture 1. We just begin with the basics. We'll be covering just sequentially chapter 1, 2, 3, 4, and we're recording and posting on YouTube. The YouTube channel, it's a channel. It's K.M. Petrov, okay? That's my name. So when you go to YouTube, you just type K.M.P.E.T.R.O.V. and you're gonna get to my channel, and you're gonna see either fixed income securities or, for short, bond markets. And chapter 1, we basically, let's first clarify that we have as textbook is Pabazzi, sometimes you may read it in the original Pabazzi, okay? And the edition is 2010. So as I'm teaching, I'll be giving you usually the pages, or if I'm explaining a concept, you can ask me which page. So as I'm explaining on the board, you got reference. So first of all, we begin with the basics. Chapter 1 is Introduction. And we begin with basically what's a bond. And we say that a bond is an instrument of debt. And debt is in turn an instrument of an obligation. And I'll be explaining basically the different concepts. First of all, a bond will have an issuer, okay? And issuer is someone who issues a security, okay? A security. So basically, I'll be explaining all of those simple, easy, basic concepts which you've studied in financial economics. So, security has a number of different explanations and definitions, but the best, the shortest, and at the same time the easiest, which of course is the most correct, is that a security is simply an asset which is someone else's liability. So, security is an asset which is someone else's liability. So, what does it mean? It means that if you have a bond, and a bond is a security, those who own the bond, for them, it's an asset. Those who issue the bond, for them, it's a liability. Let's try another security. Another security will be 1,000 of these New Taiwan dollars, okay? Right? Can you zoom in on these New Taiwan dollars? Right? You're zooming in? Well, unfortunately, we can't read it. Oh, I can't read in here, but this is, for me, an asset, and it's a liability for the issuer. The issuer is the Central Bank of Taiwan. So, which are the typical securities? typical securities are number one, stocks, and stocks are issued by corporations. Number two, bonds. I'll be explaining in the next 10 or 20 minutes. Issued by whom? And number three will be currencies. And the currency is the liability of the central bank. For the Japanese yen, Bank of Japan. Okay? For British pound, Bank of England. So, a bond is a security. And a security is an asset, which is someone else's liability. Okay. The issuer, for the issuer of a security, the issuer has a liability. So, for the issuer, the bond is on the right-hand side of the balance sheet. Okay? All right? Now, how do we call those who buy bonds? Okay? If they buy bonds, we actually call them investors. So, an investor is someone who buys securities. But not only securities, who buys also stocks, bonds, currencies. You also have all assets are you zooming in big? You man zoom in or not zoom in? You gotta zoom in. So all assets are either financial assets or they are real assets. Financial assets are called, for short, securities. So, which are the real assets? Real assets include real estate and commodities. Okay? So, commodities like oil, gold, natural gas, rice you eat every day, soybeans, tea, coffee, sugar, okay? All of these are commodities. So, investors will buy either financial assets, and financial assets we simply call, for short, securities. So, you have five primary asset classes. And the five asset classes are stocks, bonds, currencies, real estate, and commodities. Okay? So, this course will cover only and exclusively bonds. There are separate courses that cover stocks. There are separate courses that cover currencies, okay? Those that cover currency we call international finance, okay? There are separate courses that cover real estate, it's called real estate finance. And currently, some universities even offer courses in commodities finance, but usually it's not part of the typical program. All right, so we have issuer, okay? And the issuer is sometimes called debtor. Okay, so the issuer is called debtor. This means that he has a debt, the same as obligation. And the debtor is also called borrower. Okay? If you have any questions, you just stop me and ask, okay? Next, we have investor. So, the buyer of a bond is called an investor. And the investor acts as a lender. All right, you're zooming in nicely, right? You zoom in there, you keep for a while, right? Okay, lender and investor. Okay, bonds usually pay interest. So, interest is the compensation for using money. So, interest is paid when you borrow someone else's money, and interest is exactly the same concept as rent for real estate. So, interest, a better way, an easy way to say, is the rental price of money. What does rent mean? Rent means you take an apartment, you pay rent, and then at the end you return the apartment itself. So you borrow $1,000, you pay interest, and you pay the original amount. The original borrowed amount is called principal. So principal is the original amount. It's actually more correct to say is that the principal is the amount that's paid back on maturity. And principal is also known as face value. Okay, face value. The typical face value for a bond is, are you zooming in? Oh man, you gotta zoom in. If you can't zoom in, you can't, sleep. Zoom in. If not, if you don't want, let's just replace it. You wanna do the recording? No, you don't want to do the recording. If you guys don't want to do the recording, we don't do the recording. You don't care. Nobody cares. Here, you don't give a damn. Okay. All right. So face value. So face value. So when you have a bond pays interest. And that interest is called periodic interest. Periodic interest means that it's paid every period, meaning every 3 months, or every 6 months, or every year. In the United States, it typically pays every 6 months, periodic interest. At the end is called maturity. Maturity. Maturity represents the end of the life of a security. It is when the security is paid back in full and retired. So on maturity, everything is paid off and the security disappears. Okay? So security represents an obligation. The obligation is completed. It's called maturity. Okay? And maturity has two forms, two ways to think. One is to think in terms of term, and the other one is in dates. The term will be 5-year bond. 5-year bond means a bond which matures in 5 years. So in 5 years it will be paid in full. The alternative is to say the date. If today's 2011, the date will be 2016 bond. Okay? So a 5-year bond is the same as a 2016-year bond. So you can say the length of life or you can say the date, or the year, or the month on which it matures. It's the same thing, okay? So you have two different concepts for maturity, okay? Is that fairly clear? Let's see what else we have. Okay, well, that's actually the very first section. Now we get on the next section, and the next section is sectors of the bond market. All right. The first sector is the Treasury. Treasury. Okay. And the Treasury is the sector where the government issues the obligations. So, Treasury means that the Treasury will have three types of securities. Let's have them one by one. It's going to have a Treasury bill, then Treasury note, and Treasury bond. Okay, I'll be explaining those, but usually a bill is less than 1 year. So, Treasury bills, we say, mature within 1 year. Okay? Treasury notes are up to and including 10 years. Some people say 12 years, but 10 is good enough. So we say between 1, so it's greater than, let's see, let's just say less than 10, okay? Less than 10. And bonds will have, we say, 10 plus, as a maturity of over 10 years. Okay? Is that fairly clear? Let's see what else we have. The second sector is called the agency. Let's see if I miss here. No, I didn't miss here. Okay. Agency sector basically means government agencies which are somehow associated with the government. Okay? So these are, we call these federally related institutions or governmentally related institutions. And we're going to be having a complete chapter discussing all of these. Then the next one is called municipal. So that's the municipal sector, and you're going to have respectively municipal bonds and so on. Municipal means of the local government. So this means of the state or of the county, or possibly even smaller one, school district. So the state of Ohio, the state of New York, or whichever, Broward County or Orange County. So these you call municipal. So municipal means of the government at the local level. Okay? The next sector is the corporate. And here it's very simple. These are securities issued by corporations to finance their operations. Okay? We have a whole bunch of them. The first one is bonds, and bonds are typically, or we associate, you have to understand, we associate bonds with long-term securities. I will be explaining those in a minute. The next one will be, let's make sure we get it right. Yes, medium-term notes. And notes may have interest, may not have interest, okay? And these will be typically between 2 and 7 years, okay? Next one is, let's make sure I get it right, commercial paper. A commercial paper, again, is issued by corporations. It is short-term and finances usual some seasonal financing needs. So commercial paper is usually up to 270 days. I'll be explaining that later. Basically, it could be commercial paper for 1 week or 1 month or 3 months, 6 months, usually up to 9 months. Technically, commercial paper is usually up to 1 year, but in practice in the US, you don't get up to 1 year, you get up to 270 days for tax reasons. Again, I'll be explaining all that in coming lectures. Yeah, you get this tricky thing called structured notes, and I really don't want to get to explain them now. When we have the whole chapter on corporate debt, I'll be explaining in great detail, probably over 2 weeks, over those little details. All right, so all of these corporates can be what's called investment grade. Investment grade. Investment grade means high quality, means very low risk. It means good borrower, okay? The alternative is non-investment. This little sign is called tilde and means same as before, same as above. So it means non-investment grade, okay? You zoom in. All right. So non-investment means high risk, low quality, possibly bad borrower. So we like to think in terms of default. All right, zoom back in here, default. So, default occurs when the debtor or the borrower does not satisfy his obligations completely. In other words, the borrower cannot pay either interest or principal in time and in full. So the key to default is that he may be able to pay 70 or 80%, but that's not good enough. If he can't pay 100%, we call it default, okay? Also, if he can't pay on the maturity date, it's again default. You know, it's no good. They say, oh, we'll pay next month. That's no good, okay? So, default. And we have therefore a risk of default. And getting back to investment grade means relatively low risk of default. And non-investment grade means relatively high risk of default. And non-investment grade back in the good old days was known as junk. And they were called junk bonds. Junk bonds. So junk stands for high risk, which is the same as non-investment. Is that fairly clear? All right, move on. Is that fairly clear? Okay, let's see what else we have. Oh, ABS number 5. Asset backed securities. Okay, let's see what we have here. All right, so here we have the concept of securitization. And to securitize means to pull together a number of assets and use them to back another security. So you get 10 loans together, and these 10 loans will back a new debt. Okay? That process of pooling assets together is called securitization. Usually when you securitize, you get some assets, you pool them together, and then you issue a new security, and that new security is backed by those assets. I will be explaining, and very likely will spend at least 2 or 3 weeks on securitization, on the details, how it works and all the details, okay? So again, not the time now to explain. And again, asset-backed securities, they can be backed by mortgages, they can be backed by corporate loans, they can be backed by student loans, by all sorts of things. There's going to be a whole chapter on asset-backed securities, which we'll most likely be able, at the very end of the course, to cover. All right, and the last sector is called the mortgage sector. We call them for short mortgages, but it can be also mortgage bonds, and I'll explain the difference. So basically, a mortgage is simple. A mortgage is a loan to purchase usually real estate secured by real estate. So a mortgage is a loan secured by real estate. Okay? So you can take a mortgage to buy a car. Doesn't happen very often, but it's still a mortgage. I mean, you mortgage your house, you secure your car loan with your house. Usually, when you have a mortgage, you usually buy a house, or usually buy real estate. So 95% of the time, mortgage is secured by real estate for the purchase of real estate. Okay? So what does mortgage means? Means that you use the house as a security. But here, security has nothing to do with this security. Okay? So this security is the same as financial instrument. This security has the meaning of a pledge. Pledge means that if the borrower cannot satisfy the loan, meaning if the borrower defaults, the lender will take the pledged asset, will take the security, okay, and will satisfy the loan with the asset. So this type of loan is actually, because it has a security, it's got a special name and is well known in finance. It's called secured loan. Secured loan. So a mortgage is a loan secured by real estate. Okay. And we say that the lender has a lien. Lien means that the lender has the right to repossess the property, take ownership of the property, liquidate it, and use the proceeds, meaning liquidated is the same as sell, and then use the proceeds to actually satisfy the loan. Okay? Let's see what else we have. Mortgage. Okay. Mortgages run in two types. The first major type is residential. Residential, in the simplest term, means where people live, where people sleep, meaning where people use is their residence. Okay? And the opposite of residential is called commercial. So, let's provide a few examples of commercial. Well, this university represents commercial real estate and maybe possibly backed by a commercial mortgage. So commercial means used for business purposes to generate profit. That's the meaning of commercial. So the most common example of commercial, which you usually use every day, is shopping mall. All right? So commercial property will be shopping malls, okay? Will be corporate offices, could be possibly parkings, could be possibly garage, could be possibly warehouses, okay? So all of these are used to generate profits for business purposes. Residential is where people just go and sleep, okay? And they use it as their primary residence. An example where we have businesses that offer real estate to sleep will be hotels. Hotels count as commercial because they are for profit purposes. Fairly clear? Yeah? Okay, let's see what else we have. Yeah. Within these, especially within residential, you have loans which are called prime. And therefore, we call them prime mortgages. Prime means of high quality. And prime is exactly the same as low risk. So, when you have for corporate loan, you call it investment grade. When you have it for mortgages and consumer loans, you call it prime. Okay, so prime is associated with the highest quality of borrowers. The lower quality is called subprime. And subprime basically means high risk. That's it. Subprime borrower means high risk borrower. And high risk means high probability of default. Now, let's define the concept of risk. Risk basically means the probability of a bad event, of a bad outcome, usually associated with loss. Okay, usually associated with loss. Now, let's explain risk. Why risk does not necessarily mean loss. As I was teaching in Saudi Arabia, I'm explaining to students that, hey, the king of Saudi Arabia will be real happy if oil prices are $120 per barrel. He's real happy and making hundreds of billions of dollars. He's okay and he can cover his finance spending if oil is between 85 and 90. For the king, the risk is that oil crashes down to $50. Now, if oil crashes down to $50, does it mean that Saudi Arabia takes or runs or has losses? No, they still make an awful lot of money. A barrel of oil in Saudi Arabia is estimated to cost $5, $7, $8, $10, okay? That's the average cost. So even at 50, they still make huge profit, okay? But the risk is that the price will be relatively low and they're going to be making below expected profits, okay? So risk is associated with what we call relatively unfavorable. Relatively unfavorable does not necessarily mean loss, okay? So that's important to understand. Similar with default. Default does not necessarily mean loss. They may default, they might not be able to pay today, but over time they may be able to catch up or somehow recover the losses down the road. Okay, so you have prime mortgages and prime borrowers. You have subprime mortgages and subprime borrowers. Okay, and that's basically this section. You want to take a break, 10 minutes? Or continue? All right, let's take a break. So push the button, record button.